Hey guys, welcome to another episode of 21st Capital. Today is Friday, March 7th, and we are going to analyze market's reaction to the strategic Bitcoin reserve. If you have followed the news, last night we got an executive order by President Donald Trump that ordered the Treasury and Department of Commerce to establish a strategic Bitcoin reserve, which is supposed to hold the forfeited Bitcoin and crypto that the government holds, and not sell it. And it also leaves the door open for purchasing more in the future in a budget neutral way. So we're going to look at what happened to the market after that. If you're aware of the price action, the market immediately dumped, which was really funny. And today we are going to look at some of the data and decipher what's going on. And as usual, we also have Crypto Wizard with us to explain what's going on in the data. Hi, Wizard. How are you?
Hello, doing good, doing good. I'm excited to get to the data.
Awesome. So first things first, today we actually have an important announcement as well. We are about to launch a data service which is called Bitcoin Intelligence. I've announced it previously on Twitter and a few other places, and given people the link to join the waitlist. You can now join it at 21stcapital.com, waitlist-bi. And this will be released pretty soon, in a matter of days, and it will include our analyses, which includes written reports and video. So today's session is also going to be a permanent part of that product, and you will also have access to our charts and results, including the quantile model and the power law models that we have developed. And we will also be expanding those charts to many more, including the critical on-chain charts and derivatives charts, and so on. So you can join here, and it will be a mix of free and premium content. We will always keep a free section where we look at the overall behavior of the market. And then in the second part, which will be only for premium users, we will get deeper into the data and offer a much more in-depth analysis. Similarly, we are going to restructure the videos we are doing with Wizard. Typically, moving forward, perhaps not the first week, but after that, we will have two sections of video: one general content and helpful overviews of the market, and then the second part, we will switch to more premium content. Again, going deeper on the results. You will have the same experience with our written reports. So we're going to do a weekly newsletter where we look at the market and provide you with our perspective. Again, that also is going to have always a free section where some important analyses are placed, and it will follow with a much more detailed report. Okay, so that's our announcement. We've been working on this for God knows how long. A lot of time and effort has been put into this. Especially, we've developed a complete chart platform, which in a matter of few weeks is going to have tens of charts and useful content on it. We are very excited to share that with you and finally launch it. We have hundreds of people in the waiting list already. Definitely join if you're interested. And find us on social media to give us feedback. Okay, so with that, we can begin our discussion today. As I said, we got the strategic Bitcoin reserve, but it was clear that people are very overly optimistic about it. The a famous tweet last night was, this is the last time we can buy Bitcoin under $250,000. Pretty impossible thing to go from 89 to 250 in a couple days, but it was very got a lot of engagement as always. So those things were actually precursors that told me, once I saw those, I was like, the 100% we are going to crash. And we actually did, especially because we knew that the aggressive purchase by US government is not going to happen. So people were very overly optimistic about it. So as expected, we got a crash. We had an attempt to recover the price damage, but the price kind of briefly touched 90K today as well, but it got rejected again and went back down, indicating that there is weakness in this market. Most of the weakness, in my opinion, is coming from macro backdrop, but what's happening to Bitcoin is fantastic, and it's very positive in terms of the fundamentals. Especially this SPR itself is a historic event that officially makes Bitcoin a nation state grade asset. So that's all we wanted. I personally didn't like to see the US government accumulate a lot of Bitcoin. Taxpayers would probably not love that. The ones that don't really appreciate Bitcoin wouldn't like their money going there, and it would have been a really difficult battle within the government to do it. So really unrealistic. But the idea that they are now just officially approving it and officially accepting it as something that the government feels bullish about, that's very important, and it's going to convince and motivate many people in powerful positions in different governments to also do the same. So if you're an official, like a treasury secretary in a different government, now you can come back and say, hey, United States has some Bitcoin, why shouldn't we? And we are already hearing from several other countries that their leaders are discussing, we should get into Bitcoin in terms of either purchasing it or mining it or something like that. And I suspect purchasing would require them to devalue their currency to buy Bitcoin. So that's a lot harder. But mining is very easy, especially for people that have an overabundance of energy. Belarus leader was kind of entertaining the idea that we should mine Bitcoin. We are hearing a lot of news from Middle Eastern countries. They are oil and energy exporters. It makes a lot of sense to export some of that energy to the Bitcoin network and accumulate some that way. It's a permanent buyer of energy. Why not? So this is the effect of the SPR. However, market-wise, because the government is not buying anything, people are upset, obviously, based on the price action. So what do you think about it, Zi? Muted?
Yep, always I forget to. Yeah, I think, to be honest, I was pretty surprised. That was a smart move. But at the same time, the number of reads and different reactions or prediction and speculation that, from my perspective, was super bullish, unnecessarily bullish, now is cleared up, which I'm happy about. But the good part about, like, if I want to be realistic, I was like amazed that they didn't propose we're going to use tax money or, like you said, devalue dollar to buy Bitcoin, because that would be so stupid, even for Bitcoin. the government has deficit. They have budget deficit, and they're not making enough money to just meet their expenses. Now they're coming buying Bitcoin out of taxpayer money. That would be stupid, but they acted really nice. They kept their promise. The campaign promise was they're gonna have a Bitcoin treasury, which they did. They distinguished Bitcoin from altcoins. That was very interesting. I mean, Bitcoin, I always say Bitcoin doesn't need governments, but governments need Bitcoin, and they acted smartly in that regard. And they let it be open to buy more Bitcoin, but that term they used um, I think they said budget neutral, but what they said like no like
Budget
uh,
neutral. Yeah.
yeah, I think it's up to Congress to find how they're going to do that. Probably confiscated from criminal or whatever it is. It's not going to be
But
taxpayer
that
money.
that just doesn't make sense because because they don't have any money. It's all deficit, right? There's
Yeah,
nothing like budget neutral. Like where are you gonna find like any dollars you're spending on Bitcoin, you're not spending on some other program. So um it's not
I think
like
the
they
only
are
way it's like I'm telling you, buy a car, but budget neutral. You either have to steal it, you get it by force. Like
yeah,
I don't see
yeah,
any
yeah,
other way.
exactly.
It's going to be budget neutral. But it was interesting. And like you said, market was over bullish, and the sad part was that over bullishness was not only limited to the Bitcoiners, it was going beyond Ripple, Solana, like all shitcoiners were getting excited, which actually benefited the VCs, as you can see. And you could look at the data probably today. I show some of them. You could see the majority of people who realized some profit during that, I mean, flow was the people who recently invested, and the people who realized loss was the people who bought recently. So a lot of uh, people positioned themselves, but some apparently had some edge, and they bought at the right time and sold at the right time. And the retail always buy at the top and sell a very bad moment, and that was the sad part.
Yeah. I was also honestly very happy. I mean, amused that the price was dropping because I was very frustrated by the dumb, bullish, crazy bullish, like absolutely crazy numbers people were dropping. And then, but I get a lot less frustrated these days because when they do that, I just go and open up a bearish position. Like I had a covered call right before the SBR, a couple days actually before the SBR announcement, because I knew it's not going to be something overly exciting. And I just now make whenever I see so many bullish news, I just make money off of it. Um, and looks like that position just closed with another 100% profit. So in that regard, I appreciate those bad influencers. Um, okay, so let's see. Let's see if I have my valuation updates, which we can take a quick look at, and then we can come back to our on-chain data.
Sure.
Okay, as you guys know, I like to develop risk models for Bitcoin. And yes, and for now, what we have spent a lot of time on involves trend-based models that use regression analysis to examine our position in a spectrum from undervalued to overvalued. Now, let's see if I'm properly sharing the screen. Okay. If you look at these couple of models, this is the familiar power law model. Again, this model finds the best trend line that you can draw for Bitcoin. Using the historical pattern, you can figure out this relationship, pretty strong relationship for years. It has been in there, and it has a very simple equation. And what we see is that because this line basically models your average price, and you can see in the bull market we are above it, in the bear market we are below it. So this line could actually be treated as as Bitcoin price when you exclude the bubbles. In other words, it's kind of a fair price. So using that fair value is actually puts us at 90,000. For the first time, this has increased to 90,000, and the actual price is kind of flirting with it and playing up and down around it. It can go below, can go even significantly below it, but I use this as kind of the anchor, right? This is like, if the historical trend continues, we will always come back to this line somehow. So if this is continuing, which it always does, Bitcoin is growing and fundamentals are just progressing regardless of what the price does. We were also on the same show or on our own channel when we were like in here, we were saying, okay, we have a lot of gap from the fair value, so we should quickly be recovering it, and we certainly did. Same thing happened here. When you're above this line, it tends to pull you down. Now, what we have done here with this metric, which is called Volatility-Adjusted Power Law Index, we are converting those deviations into a valuation metric. Now, just to summarize it, this model shows us that this metric, VPLI, is now at 49, which is almost neutral. So it shows us that based on the historical trend, Bitcoin is kind of fairly valued. And there's zero bubbles that we can detect, at least with this analysis. So it's a fantastic place to be, and fundamentals are very strong at this point. And this is a great combination to have an asset that has very strong fundamentals, but for whatever reason, people are willing to sell it. Could be because of some macro uncertainty, could be because of some volatility with Bitcoin reserve discussions, whatever. But this is how I value Bitcoin, at least for midterm decisions. So that's it. Like I said, pretty soon after we launch our Bitcoin intelligence product, you'll be able to access these yourself. Again, that's our waitlist link. And you can check these yourself as well. And on a weekly basis, we'll be reviewing these and analyzing where we are in the market and what are the risks of reversal or a spike. All right, so I'm going to stop there and hand it over to Zi, that who is going to bring us an in-depth look at how the market reacted to SPR, who's selling, who's buying, what's going on, and enlighten us with his knowledge.
Okay.
Right, over to you.
How is the Zoom? Is it like clear enough?
I think it is, yeah. And whenever you want it, I can remove ourselves.
Yeah, sure. I think like please, I hope whoever watched this video, please let us know about the Zoom, because I have to optimize it for next round. But this week, I hope it's clear enough, and I have to just do this. Okay, nice one. So since like Sina explained, we want to like have a framework for our upcoming weeks, including this week. So we're going to have a framework. First, we want to just look into the data and have a general market risk assessment. And by that, I mean we're going to use the same set of charts, and people will get used to it and they will understand it. Because if you want to use different charts every week, maybe a lot of audiences get confused with the concept, with how you have to interpret this chart. And usually in a short episode, we don't get to explain the concept and also use it. So I thought this would be better to use the same set of chart, but the way we chose these charts, we're going to give you a holistic overview of the market, and we try to cover all aspects, but you only use the on-chain data. And it has 3 sections. First is the macro, looking at the macro metrics, the one that are very good in tracking the cycles, like saying where we are in the cycle, assuming that cyclical behavior is going to persist. In the second part, we look at the activity, like how active is the market, like how the participants are reacting to the ongoing market events, market structure. So this one doesn't have to be cyclical, but human behavior is cyclical, unfortunately. That's why it becomes cyclical. And at very last, we look at the short-term holder and long-term holder, or I can put it that way, the demand and supply side, because the long-term holder behavior is literally representing people who hold their Bitcoin and they're not volatility sensitive. They usually wait for a specific profit margin and they start to realize profit, and they're patient. That's why I call them the supply side, because their behavior is representing the supply side. And the short-term holder, which is mostly or most likely involving the new investors, the one that actually heard about Bitcoin recently, they start to buy. Not that all of them are going to be short-term holder, but majority of them are recently joining the market and they are price sensitive. It's been proven they're price sensitive, meaning any up and down is going to determine what is their immediate reaction. That's why we focus on them. And the local bottom and tops usually is formed by the reaction, and cycle tops and bottom, the global top and bottom, usually is more influenced by the long-term holder. And that's it. So three section: macro, activity, and then long-term, short-term holder. Let's get into the macro. In this chart, you're seeing a blue trace line and an orange trace line. The blue one is around like 82,000, and the orange one is around 43. The blue line is 200-day moving average. It's pretty well known in Bitcoin space, both in technical among the technical analysts and also on-chain analysts, for different reasons from my perspective. And the orange one is the cost basis of the overall market, like all investors in the market, including the coin that Satoshi mined at like early days of Bitcoin. So this is a little bit skewed because of that, but it is a really good price model that have been very strong in tracking the cycle bottoms. Like when the market in general drops below the cost basis of I mean realized price or cost basis of the market, you could see that that was the bottom of the bear market, because that means absolute pain in the market. Majority of the investors are underwater, and to our surprise, we have met that price level in almost every bear market so far. And right now it's 43,000. I feel this cycle we might not get to that for different reasons. I don't want to get to them, but let's see what happens. It's good to know how deviated from we are from that cost basis, because more we are above that cost basis, that means the bubble is bigger. So at the bottom of this chart, and the reason the 200-day moving average is important is roughly 50% of the Bitcoin price history was traded above the 200-day moving average, and 50% of the dates were, I mean, past or was like below the 200-day moving average. So it's a statistical important midline in the market. It was around like 86, I think 80. I have to zoom in. It was around 82 actually. As you can see, we hovered around 82 recently a lot. At the bottom of this chart, you can see I added a color code. This is in 4 different colors, and we keep using this color code in all upcoming charts. It's telling us the risk in the market. Like Sina said, we are interested in developing risk models, not predicting the price. Because if you become risk oriented or react to the risk in the market over time, you will be in a smart investors. You're not predicting what's going to be the price tomorrow, next week, or next year, but you're going to react to the price today. If it's overpriced, you better the risk. If it's undervalued or below your fair value, then you can start to invest or DCA in. I mean, in a big steps. That different people can react differently, but here we are looking at risk, not the price. So here we are in the orange line. What does that mean? That means we are very close, and the orange code is very close. We are very close to 200-day moving average. So the ratio of the price to the moving the blue line at the bottom is the ratio. The ratio is very close to 1, but still we are elevated if you look at the realized price or cost basis of the market. That's it's colored orange. That means we are not in red anymore, because in the red color we are, both models are signaling risk. That means we are way deviated from 200-day moving average and cost basis of the market. But orange is where we are elevated from the realized price perspective, but we are getting closer to the blue line, which is the 200-day moving average. And as you can see, in the bull market, we spend a lot of time above of it. At early stage of the bear market, we hover around the 200-day moving average, which is the midline, the statistical or technical moving average of the market. Then we break below. I'm not saying we're going to repeat this behavior, but there is a higher chance, if we assume there is a high chance for this behavior if we believe in cyclical behavior of the Bitcoin. And we don't know if we're really going to get to the orange line, which is the cost basis, but having the number is going to give you some perspective. That's why we color code this structure at the moment in the market as orange. That means we are above the cost basis of the market, which is the orange, and we're very close or close to 1, or the ratio of the price to the 200 day moving average is close to 1. So it is the risk is cooled down a little bit from the red, which is way above those bull model, but it still is elevated. So the market still has some risk in it. We cannot call this is undervalued if we look at the cyclical behavior of the market. The second macro metric is looking at the percentage of the coin that are in profit. Literally looking at every single active coin circulating coin, estimating the cost basis of that coin, and see if the price is above that cost basis. We call it this is in profit. If it is below the cost basis of that coin, or the price that it was moved before, we call it that coin. We label it as a coin that is in loss. By looking at the share of the coin in profit, we are somehow looking at, indirectly looking at the dominance of the profitability in the market. Like at market tops, you can expect that majority of the coins, because we are hitting, reaching to a new all-time high, the majority of coin, 99%, above 90% of them are in profit, because the price is above the cost basis of all coins moved so far. As soon as we hit a bear market, or we are realizing the top have been in, you could see the people who bought at the top during the first drawdown or crash or correction after all-time high, they are holding and they bought at the top, and they're going to be in loss. That's why you see usually at first stage of the bear market or bear phases, there is a sharp drop in this metric, because market have been top heavy. By top heavy, we mean there was too much euphoria. A lot of people heard about Bitcoin and price was going up, and a lot of people bought it. Now price is below their cost basis. A big chunk of the supply is going to be in loss. That's why you could see after we drop below 90, I think 96, 95, that mark, this metrics drops below the red line, which is the high risk line. And right now it's around, I think 80%. Let me zoom in, almost, 80%. Right now we're at 80% supply and profit, which is very similar to the cyclical behavior of the market. Usually after having a new all-time high, that crash to the orange line to the red line, which is around 70 to 90% of supply being in profit. But one could say, hey, look at the China ban, or look at the 2016, 2019, couple of times we dropped to this range, and still bull market kept going on. That is a valid statement. So that we can use this to counter argue, no, we have not entered a bear market, we might just bounce back. Yes, everything is possible. But if you want to solely look at this chart and say, what is the risk? How the market look like? We have been spending in above the red line, which is the high profitable market, or let's say euphoria phase. We have been there a long time. So market had its profitable days so far. Yes, we might have a catalyst. We might have a lot of people were hoping SBR would be that catalyst, and we have a bounce back above 90% profitability or euphoria in the market. But it looks like it was not the case. So one could say, yes, we spent a lot of time above 90%, and market had the profitable days already. Probably this momentum has been lost, and we might see number below 75% of supply profit, meaning we might see more weakness in the market. That is the expected from my, outcome from my perspective. But this is the market that everything can change the direction of the ship in a moment. So don't look at this as a, I don't know, engraved law on a piece of stone and nothing is going to change it. Looks like we have that euphoria, and we should have expected this, bearishness in the market. So from first two metrics perspective, we are in a cool down, post all-time high, low, moderately lower risk, but still risk is elevated, and the drawdown in the market, risk of drawdown is still existing. If we break below the orange line, or I don't know, maybe to the green line, which is the low risk line in this chart and other charts, then we can say for sure market is an extreme undervalued situation. Right now, it is a slightly overvalued, but close to the neutral valuation, similar to the Sina's model.
So there is the orange designation, but it's in the lower end. So
Exactly.
we'll see. Like if it drops a little bit, then we will fall below the orange.
Yeah. Usually in a sustained bull market, it is very well expected, like late 2024, that we get to this midline and then market again just keep going up. So if we want to see a catalyst, nowadays is the day. Otherwise, this weakness persisting in this bear phase, causing the risk of drawdown to go up and up again. So yes, and we have to look at the aggregate interpretation of all these metrics. But so far, two macro metrics are saying we are very close to neutral, still elevated risk in the market, post all-time high, similar to Sina's model. So from risk perspective, these two are saying, okay, we still have risk, but very, very close to the midline in the bull markets. The scary one is this one, actually. One of the scary ones is the net unrealized profit loss. It's the NUPOL, we call it, literally measuring the amount of profit in the market, unrealized profit in the market, and then divided by the market itself. Like it's the net profitability in the market divided by the market cap. So we are just discounting the losses and just look at the profit and see the net profit in the market. What is the ratio to the market cap? Currently, it is around 0.5, and the midline in this metric is 35, 0.35. Right now it's 0.50. So considering the high band, which is around 0.6, we are very close to the high risk level in the market, meaning the net amount of the profit in the market very close to the 60% of the market cap. Usually market had been experiencing exhaustion on the demand side. We had too much profit in the market and incentivize people to start to spend and exit the market. Right now, we have not get away from that high risk much, and we are still, far away from the midline, which is 35. And that is what is scaring me. It is, if I want to put it simply, we are seeing the dominance of profitability is declining to the midline, but the size of profit itself, magnitude of profit, mostly the long-term holders, the ones that are bought like long time ago, is still significant. Meaning, if we have a little bit uncertainty, if we have a longer bear market, they have the chance to exit the market, add to the sell pressure, while they are still in profit. You know what I'm saying, Sina? Am I clear?
Yeah, so basically the way I understand it is there is this group of people that are in profit and they're still in a lot of profit, and the recent crash probably caused other people, like maybe short-term buyers, to go into loss. But there is this huge cohort that has a lot of profits on hand, and there have probably been, more stronger hands that they don't think it's fair. It's a good price to sell at, but they still have a lot of profit, so it's a potential risk.
Yeah, and this is the scary part, but the positive part is what amazing me. Look at the China ban. Okay, like the China ban, it was a mid bull run, I would say, very similar to what happened in last year, and they got like almost close to the midline. Which was 0.35, but in the 2024 market was more resilient. We didn't see that sell-off, that de-risking that pushed the price down, and we had actually patient buyers that we discussed in previous episode. So I'm saying there is a chance that those strong hand, new, probably institutional buyers do not react like the whales or big entities or long-term holder in previous cycle. Probably, maybe it doesn't get to the midline, and because these are all statistical bands, the green line and orange line, maybe next cycle start to drift a little bit higher and higher, and we have different definition of the risk bands. But if we just take the last, these are all 4 years rolling window, by the way. If we look at the last 4 year, including last cycle, we are still in a situation that there is a potentially close to high risk structure in the market if we consider the amount of the profit. The dominance of profit is getting smaller and smaller. The number of people who are in profit is getting smaller and smaller by correcting to 88, 78. But the amount of profit which is in hand of the long-term holder, I mean a smaller number, but chunkier profit, they are still causing the market to be a little bit overvalued or too much profit in the market if we consider only this metric. But like I said, top 3 macro charts, they're saying orange. I use the term orange, which means risky. It'll be cool down from the all-time high, which is the red color, but it's still elevated risk from macro perspective. By macro, I mean macro on-chain metrics. Do you have any question from this about the section, Sina?
No, sounds good. Just waiting for some positive.
Well, I mean, as an investor, if you want to get into market, you actually should be happy for these metrics all go to the green, or which means like we have enough correction in the market that all of them go to the low risk. So depend on who is asking, but yeah, looks like all of them are hinting a little bit high risk in the market. Now we move on to activity, because so far we talked about profitability, the number of days we are above the midline. So most of the macro metrics looking at the profitability, unrealized profit in the market, how market has been, I mean, investors have been positioned themselves, I mean, in this current over the recent days of current structure. Right now, we can look at how they're reacting to the market, including miners, ETFs. We're not like looking at a specific category. We're looking at the market in general, how market is reacting to the recent moves in the profitability. The first metric we look at is the ratio of profit being realized. Like let's say someone realized some profit 40,000, and at the same time some people realized some loss in the same time because their cost basis was above this I mean the spot price at the moment. We look at the ratio between these two. When this ratio is really high, that means the majority of the coins are moving in profit and mostly profit being realized. Like you could see here, we went all the way to 27, for example, in January 2021. Or in March 2024, we went all the way to 39. That means for every dollar realizing loss, there was $39 realizing profit. That means market is extremely profitable. So we used a static threshold for this one. We didn't use like, I mean, the dynamic rolling window because it is very stationary and it's in logarithmic. So we decided to use like a threshold, but the people who are interested in quantitative analysis, they can develop a dynamic risk level. But bear with me. I mean, I looked at the recent years of data. This was cleaner to use. I mean, a static threshold value. The red line is 9. That means 90. The ratio is more than 9 to 1. So more than 90% of the coins moving or energy being released in the market was true profit. So plus $9 for every dollar realizing loss. The orange one is 3. That means more than 75% of the coins moving around or profit being realized is the ratio 3 to 1. And the green is 1. That means 50-50. For every dollar being realized in loss, another dollar was realized in profit. As soon as we break below 50-50, meaning the amount of loss being realized in the market is above the amount of realized profit, that is a low risk moment. That means market is undervalued. That it means from this metric's point of view, the amount of loss being realized is surpassing the profit. That means market is in pain. Right now, I mean, it's a good sign for people who are looking for undervalued situation. the recent crash to 80 or 78,000 pushed the 14-day moving averages metric to around 2.1. That means we're in a low risk. See the yellow one, we're in a low risk. That means we are not in elevated risk anymore. So from this perspective, that means the activity or the reaction of the market to the recent news, which was after Trump tweeting and then saying, and probably the negative side was people were overreacting, and then they figure out, okay, there's not going to be a serious buying pressure from government side. There could be a lot of speculation about the reason, but the crash to 78 push this metric to 2.1, meaning the reaction or panicking was pretty significant. I mean, I think it's the lowest since when we dropped to 49,000. That's the magnitude of the loss realization in the recent crash.
Yes. So basically, from from the recent big crash from 90K down to 79 or something, that allowed this metric to come down from something that was around 5, looks like, back to what was that?
2.1.
Yeah, so kind of caught in more than half. So pretty much a one step, one order of magnitude, one step reduction in what it means. And essentially, if you hover your mouse over December 24 in the recent all-time high, this was a period where the price jumped in 2-3 weeks from a local low to the all-time high. And as you can, exactly where you have your mouse shows the people were taking insane amounts of profits. They were realizing the profit. So previous charts were talking about potential. Here is about realizing actually who's taking profit, and a lot of people are taking profit. Now, as the price has corrected a little bit and also spent a long time in that range, a ton of profit is taken and extracted from the market. So that the more this goes on, the less the future sell pressure. So they are essentially whatever profit they had, they are extracting it from the market. So that sell pressure is weakening.
Correct. And this is one of the earliest, one of the metrics that shows the weakness in the market. Like this is getting to the low risk before the macro one, if you notice, because the activity cooled down really fast. Market gets disappointed so fast, even though there was some profitability by the long-term holder. You could see this metric is prone to be presenting the demand side. The activity is usually attributed to the new investors, and you can see the crash to 78 spooking them. It was spooking them, and the activity or realized profit or the demand momentum is cooling down really fast. But we have seen worse days like post FTX or China ban, or in August 2023 we saw this metric crash to the below 1. Like I said, the 1 means the ratio of profit to loss is 50-50. It's 1-to-1. For every dollar realizing loss, there's a dollar being realized in profit. As soon as this metric breaks below 1, that means for every dollar realized in loss, less profit has been realized. That's literally capitulation or fear in the market. Now we are close to that line. I mean, because it's in logarithmic, it's we are 2.1. We're really close to 1. But let's see what happens. I mean, we have seen 49 crash to 49 in September 2000 last year. Probably another crash to lower price is gonna just give us a very low risk situation. But I would, as an investor,
that was the max pain of 2024, right? That was a very fearful moment. I remember like the sentiment was the worst possible thing. Yeah.
And bear in mind, it's 14-day moving average. I mean, if you look at the daily, it's definitely below 1 for that specific day. But it's better to do like some sort of smoothing to just cancel the noise. And this metric is telling us this recent crash was pretty significant, but significant if you compare it to last couple of months. If you want to compare it to the last cycles, it's still not undervalued. Definitely low risk, means the activity is cooled down way lower than what it was in market top. But it's still, there is a chance, we cannot say for sure, but there is a chance that we see it could be called seller exhaustion probably, or panic selling. These terms can be used when we break below that orange line. So let's see what happens. Overall, so far we can say market still have elevated risk, not super high risk like bull markets top, but still elevated risk. From activity perspective, as I'm going to explain with the next two metrics, the activity cooled down really fast, and it's very well expected at early stages of any bear phase. Look at here, or look at here, or look here. We're going to have a crash in the activity metrics way faster than other metrics, and we're seeing the same. And this other metric that I'm going to show here is looking at the exchange volume momentum, is looking at the monthly, which is the red line, and the yearly moving average of the sum of in and out dollar value going to exchanges. We can attribute this activity or this volume to the speculators. When the monthly is dropping, that means the monthly moving average, and the indicator that show the activity of the speculator is cooling down, saying the speculators are sitting aside or being forced out of the market or flushed out. They're different terms. But when the monthly get close to the yearly, that is a significant drop in the level of activity from a speculator side. As they can see, these after the first high, a new all-time went to 108 in mid-December. Since then, we were seeing the speculation level in the market was dropping, very similar to what we saw in the first metric, which was showing the amount of profit. So after 108 in mid-December, the market was showing, even though price was resilient, it was not dropping below 100 very easy. But in terms of the what was going on behind the scene, you could see the profitability, the speculation, all of them were getting weaker and weaker. And right now we're still above the yearly average, but I suspect if we do not get any, especially after the SBR saying we're not going to go buy Bitcoin like crazy, I suspect the activity keep going down, and probably the monthly moving average go below the yearly and put the risk in the yellow or orange, because right now still it's above the yearly and it's increasing, so we call it high risk because activity is still above the yearly moving average and it's going up. But as soon as they go below the yearly moving average and keep dropping, we call them, from this metrics perspective, we say the risk is low, not from the market in general, but the activity is very similar to the structure that market is undervalued. But like I said, you have to look at all of them. So from activity, we are very close to elevated risk, the orange, but still recently it went up. This is mostly because people were trying to speculate the SBR. That's why that uptick in the activities, you can explain it, but the general trend is downward. So the activity is dropping as well. The very last one is the fee momentum. So miners revenue from fee. As you can see, this is like a, I think, 14-day moving average. This metrics is very, like, the behavior is really weird. Like you could see, it's like a pulse cyclical behavior, and the cycles are very short. It's not like a couple of years time difference between high from last cycle to the high to this cycle. This is a very short-term cyclical behavior in this metric. This is because the fees tends to go up to big events in any stage of the market. It could be in a bear market, something happens, people rushing to spend. It could be in the bull market, something happens, people rushing to spend. So this is a pretty nice metric that is not following other metrics, because as you notice, most of the metrics we saw, especially in the macro side, has a very high correlation with the price. But this one has a correlation with human behavior. And as you can see, the recent rushing to speculate about Trump's tweeting BTC reserve, strategy reserve is just coming to play. That many people were speculating, people reacting to it. As you can see, the activity in the exchanges went up, and fee as well, it went up and made the market a little bit risky from this perspective. But generally, after 108, 109, this metric has been in low risk, yellow, and is slightly during the crashes or when the bear phases was extended a little bit, it was actually signaling the green, saying we had like a little bit over reaction to 78. Market got spooked so fast, and this metric was showing a little bit low risk. But this metric is not, like I said, is not showing a long-term. It doesn't stay in one phase for long term. You have to use this on top of other metrics and not only relying on this one. Generally, if you have a downtrend in activity from this metrics perspective, the recent uptick can be explained by the speculation around SVR and Trump's policy about Bitcoin. So far, most of metrics showed we were at elevated risk from profitability perspective. From activity perspective, we are on a downtrend and we are cooling down so fast. So we have to see if there is no motivation, there is no incentive or catalyst in the market, most of these activity metrics are going to get to the green zone or under value or very low risk. How about that now, Sina? Did you get a good picture about the profitability and activity in the market?
Yeah, makes sense. Makes sense.
Yeah.
Sounds good.
Yeah. To close this section, I'd like to then go to the third part, which is talking about the short-term and long-term holder. And I hope over time, when we use these metrics more and more, we don't have to explain them and people go back looking at this episode. So I just bear with me. I have to explain it for first time, and over time we just get into the numbers and do not spend much time on explaining. This metric is looking at the short-term supply profit to loss ratio. If I want to put it simply, is looking at this metric, looking at the recent buyers, the people who bought in the last 6 months. Mostly we call them demand side, the people who jump into the market and they heard about Bitcoin and they start to buy. And some of them might be experienced investors and they hold their coin and become long-term eventually. But solely this metric is going to look at the short-term holder and measures the number of coin that are owned by these new investors that are in profit and divided that number by the number of coin owned by the new investors and they're in loss. So there's a ratio between profit and coins in profit and loss. As you can see, the very high number is saying the majority of the new buyers are in profit, like you see in 108 or when we were around 71,000. This metric went to 1,000 because this is logarithmic. That means for every coin in profit, in loss, there was 1,000 coin in profit. That's a very high number. And at around earliest stage of the bear market, this metric drops to 10, around 10, and we are using only recent years historical value to determine this threshold value. So people who are interested in quantitative analysis, they have to define a dynamic threshold line. But let's take just this static lines for today. So the red line is showing 0.1. I think yes, the red line is 0.1. Sorry, the red line is 9, and that means for every coin in loss, 9 coins are in profit, so it's 9 to 1. The orange line is 1, that means 50-50. For every coin in loss, there's a coin in profit, so it's usually a midline in the market, and these are coins that are owned by the new investors. And green is 0.1, meaning for every coin in profit, there is 9 coin in loss. That's the definition of each line. Right now, the recent crash, as Sina said it perfectly fine, because the majority of people lost were the people who bought at top. Now this metric crashed to around 0.3, meaning for every 3 coins in loss, for every 3 coins in loss, there is 7 coin in profit. So it's still, we are not in, we are below, for every 7 coin in loss, there's 3 coins in profit. That's the definition of the current state. So the number of coin in loss has surpassed the number of coins in profit. That is a significant line in this metrics, and you can see we broke below it. As soon as we the price broke below 96, we were in extreme pain for the new investors, and it went all the way to 78. I think at the lowest number we got to 0.2, 0.3 almost. So 3 coins in profit and 7 coin in loss. That is pretty significant pain for the new investors. And if we continue crashing to lower number, we might see something like what we saw in 49,000. So from new investors' perspective, the amount of pain is not as severe as what we had in September 2024. And I would like to zoom out a little bit. Let's look at the last bear market, look, it gives you a better picture. In last bear market, after November 2021, we broke below the 50-50 line, midline, and we stayed there for a couple of years. Then again, in January 2026, we broke above it. So it gives you some sense about markets overall sentiment as well. If we are hovering above the orange line, meaning more than half of the coins owned by the new investor are in profit, we are still in the bull market. If we break below this and stay there, that means the market have not been profitable for the new investors, and there is a chance that we see some sort of midterm to long-term bear market. And this is one of the scary charts. We broke below this line, very similar to what happened in June 2024. So we can expect a midterm to long-term bear market. I mean, in a worst case, look at what happened from 2021 December all the way to January 2023. Market did not manage to become profitable for the new investors, and we were below this orange line, which is 50-50 profit and loss by new investors. So let's see what happens. We could have like a midterm, short-term bear market, or we can very well have a long-term bear market. But in terms of this metric, we have triggered the beginning of a bearish phase. Let's see what happens. Probably it's a midterm. Hopefully it's a midterm bear market, but no one can say for sure. And to close this section, I want to talk about the recent crash again. After we break into 78, the new investors realized a lot of loss, like significant amount of loss, which actually, using this metric, we could have said we might expect a bounce back because the new investors already realized too much loss. They were capitulating. Usually we see a bounce back as soon as we see that amount of loss in the market, but we have to look at this long-term behavior of this metric. Are we going to see lower and lower like what we saw in 2022, or no, it was just it's going to be a temporary bear market, and this metric is literally just locating the local bottoms. It's definitely up to the metrics that we discussed in the macro side, but we can use this metric to locate the local tops and bottoms just because it's solely focusing on the short-term holders. But from this perspective of this metric, we are in a low risk if you just take this metric. But overall, from the macro perspective, on-chain metrics, we are in an elevated risk. We're very close to the midline. It's remain to be seen. Are we going to repeat the severe, painful moment of bear market that we saw in last 2 or 3 bear market, or no? This time is different. So it's up to you to answer this question. But if you believe in repeating the previous cycles or structure, we are very close to midline, and in absence of a meaningful positive momentum in the market, we might see a longer bear market or a deeper bear market. So this is the bottom line if you look at the risk metrics, and we will update you next week with the same metric as well. And hopefully, if you have any question, please reach out to 21st Capital people or me myself on Twitter. I'll be happy to explain and answer your questions.
Fantastic. Well, thanks a lot. That was the very deep dive. So basically, where we are is a lot of people are now in loss count-wise, but the other side that's in profit, they have been in profit for a long time, and they have held the coins for a much longer time. There's a lot of profit they have, but they're not taking massive amounts of profit. It's mostly short-term people that are in a lot of pain at the moment. Now, if that pain continues, the probabilities are that they might be discouraged to play so much that they give up. But it can also mean, depending on if there is an external flow of new demand, then this actually would put us in a very good place to bounce back up, because there isn't a whole lot of leverage or unrealized gains that are ready to be dumped on the market from the short-term holders. So how would you say we can track the comeback of this demand push whether it's in the data or what you think would be the catalyst in the next 6 months, what signals or what data would you look at the most?
Yeah, the easiest one at almost every on-chain data provider is going to give you some data is the cost basis of the new investors, which is around 92 now. 90, I expect to drop a little bit to 91. So why is that important? If market breaks above the cost basis of the recent buyers, which is 92, and it stays there, that means there is enough demand in the market to keep the price above the cost basis of the short-term holder. Probably they're going to spend, but demand is high enough to face that sell pressure by the new investors and stay there. That's going to encourage new investors because they are in profit for a meaningful amount of time, 1 week or 2 week above the cost basis. That is a sign the markets came back. But if we stay below the cost basis of the new investors, that means the momentum of the demand side is diminishing. There's not enough demand in the market to put these new buyers into profit and keep them in profit. The profitability, if it's sustained, is going to incentivize these new buyers to just jump in and buy again and run the bull market to the higher prices. So that's the first thing I would look at, the cost basis of the short-term holders, or that's the term coined by Glassnode, short-term holder, but we personally try to say new investors to make it more digestible for people because the short-term holder is just a little bit too technical, but new buyers cost basis. That's one thing I will look at, short-term MVRV, short-term cost basis. The second thing is, I can show you here actually. Let's see if I have the chart. Supply by age. Chart. Okay. We have to look at the share of or number of coins that are young and they have an age below 1 month. Why is that? So this is showing the share, or I think this is dollar value, or no, the number of coins. This is showing the number of coins that have an age below 1 week. Why is that important? Because these are the coins that are attributed to the new investors, the speculators, swing traders, the people who are the fuel of a bull market. When you see this metric is dropping, I'm going to just put it 30-day moving average. When you see this metric just dropping, that means, okay, those people who are responsible or the source of the fund usually for rallies, euphorias, paying the premium or facing the sell side of the long-term holders are these new buyers, these super active share of supply. As you can see, this is dropping. And when we see a jump in this or see a trend like what we saw here or like what we saw here or here, that is another confirmation of the new demand facing the market. There are, of course, more and more in-depth metrics that we can refer to, but for our audiences, I try to choose two that are easy and they're accessible. Very well, you can go to Glassnode and we have 10 or 12 different metrics that can help you in that regard, but these two metrics are available both in Glassnode and other platforms, and you can just find them easily if you do a little bit of search. So that's two metrics that I would use to, if you want to only use on-chain. If I want to go to perpetual, the moving average of the 7-day moving average of the funding rates for Bitcoin, or if you have access to other major assets, that's a great indication of the demand in the market. When we, again, we should not look for the positive and negative in the funding rate. We have to look at the above neutral value, which is 0.1%, because of Binance capping the funding rate. So the moving average, 7-day moving average of the funding rate trending above the neutral value, that is another sign, but it's not on-chain. It's just perpetual market.
Yeah. And then when you look at 2021, it's interesting that the metric you're showing started declining way before the price peaked.
Yeah, that's why the on-chain, most of on-chain, like Checkmate and me, myself, and a lot of people that are holding this side of, they talk about the 2021 differently from the community itself. The second top in the 2021 was not an on-chain. From on-chain perspective, we were in the bear market. So possibly we can say the second top was literally a bounce back, mostly a perpetual or derivative-driven rally in the market. From on-chain perspective, we were seeing the activity was dropping and dropping after the first high in 2021.
Interesting.
Now we are here. Let's look at the funding rate as well. The 7-day moving average of funding rate. 7-day. As you can see, it is dropping. Most of exchanges is dropping. And if I want to go back, look what happened in December. See, it's just going up. Almost all exchanges, or in March or February 2024, it was going up. Right now, you can see the trend or the mean value plus the major exchanges, which is Binance, Bybit, and OKX. They're all dropping below 0.1%, which is a neutral value. So demand side in the perpetual is also showing some weakness since December 2024. So it's in agreement with other metrics that we discussed, from activity, mostly activity metrics, and also the profitability of the short-term holders.
Yeah. So once energy goes out of the market, the baseline or the average metric in terms of the, say, for example, here the funding rate goes down, that means there's just less trading activity. But if it goes down further and further, it just also sets up the market very well for a bounce back if demand comes back. So it has its own positive and negative sides.
I mean, people talk about smart money, but they do not define it. I think the best or fair definition of a smart money is people who look at this data and they literally buy at the bottom. We joke about it. People laugh at it, that you should buy at the bottom and sell on the top. But you will be amazed, the majority do the other way. Like, they buy at the top and sell at the bottom because the fear, because the greed. Right now, that's why when these metric, especially funding rate, go to the negative territory, that is the best spot to buy from this metric's perspective, because people are panicking too much. So that's where smart money enter the market, because they are buying, they have cash on the side, they seize the moment and they start to buy. That's why the majority of the bounce back happens after capitulation in the market. Especially funding rate is really responsive because it's a very high liquid derivative markets. You could see the reaction in this metric is much faster than on-chain metrics. But when you have a confluence between funding rate, activity, on-chain metrics, short-term holder capitulating, and the long-term holder are close to their midline, that's where you want to be a buyer. Yes, it might correct a little bit further, but you bought at an undervalued situation rather than buying at top. So I hope we continue these weekly market reviews, and I really want to see a couple of these metrics get to the green era, and not encouraging people to buy. I just want people to experience what is undervalue means when you have access to these, because some people say it's undervalued. It is totally subjective. From their perspective, could be it is undervalued. Maybe someone called 90,000 undervalued. But when you have a common base to talk about, on-chain data, something that you cannot manipulate easily, or funding rate of major exchanges for Bitcoin, when you have these metrics and they are signaling undervalued, that gives you enough confidence to act smartly, not based on emotion. So hopefully 21st Capital, we're going to have this metric when we see some green there. And Sina, that's the kidney line. Put the pair of kidney BTC is going to just go up.
Yeah, so for now we are looking at Glassnode data, but like I said, we will be transitioning some of this data to our platform as well, to have, in addition to the proprietary models that we're developing, we will also be replicating the most important, like a handpicked set of charts that over time we have found useful. So our dashboard will keep getting better and better over time. Again, if you forgot if you didn't catch the first part, go on to 21stcapital.com, waitlist-bi, sign up, just provide your email. So once we launch the platform, we will notify you, and you can track all the data with us over time. But we will keep analyzing the data from all angles. This week we didn't have major macro discussions, but that's also part of our work. We will look at the economic trends, we will look at on-chain, we will look at derivatives, and then build a holistic picture of where the market is going. Right now, there's some level of elevated risk and not a lot of enthusiasm in the market. Plus, we don't have a great macro backdrop. But by next week, maybe we can get into get into the macro a little bit more, and that's where I explain why in the next 6 to 9 months I see a lot of positive events happening after these tariff and trade wars and all the uncertainty has damaged the market to a good extent. So it's not like being in a high risk or weak position in the market is necessarily a bad outcome. It actually can present a lot of opportunities. Well, we will be there. We will be there to track the data, whatever happens. And thanks a lot, Zi, for your fantastic presentation today. And looking forward to next week.
Pleasure, Sina. Always my pleasure. And let's see. See you next week, and see you everyone next week.
All right. Bye-bye.
Bye.